Hi, I'm Pete Andresen of Andresen and Associates. It's June 10th, and boy, if you were watching today's markets, it was a real acrobatic exposition out there. I just wanted to run some graphs by you to show you what's going on this year and to show you what we're doing at Andresen and Associates. So let's get that done. Let's share screen, and we're going to go to share. Okay, start slideshow. Okay, I can show you this. Now, I want to talk a little bit briefly, something for you to think about over the weekend about inflation. I understand this isn't the most sophisticated video, but it'll have to do because I wanted to get this out to you today. A little bit of disclaimer. This is for information. If you're my client, then you're going to see these changes rippling through your portfolio, and I want you to understand why they're happening. If you're not my client, then consider this as entertainment only. And the big thing I would say is that past history, which we use a great deal to consider investing, past history does not guarantee at all any future results. So I'm not your investment advisor if you're not my client. We don't have a crystal ball. Right now, as of June 10th, we're in an interesting place. Interesting is a polite way to put it, rather like being run over by a bull is interesting. We are seeing the S&P 500 stock market down negative 17.6% as of close of the market today. There has not been another double-digit down year so far since 2008, believe it or not. There's usually once a year down 10, but to see it go like this is unusual. We're also seeing something really bizarre. The worst bond market since 1840. It will heal. 1840 something. I forget. I wasn't alive back then, even though my kids think I was. Vanguard long-term treasury fund is 21%, which is absolutely stunning. This will reverse, and I'll talk about how that's going to happen. And cash now has a negative 7% rate of return after inflation. That means that, according to Jeffrey Kleintop over at Schwab, we're looking at the three bears, and the three bears have only occurred twice before in the last 72 years. So we're in something unpleasant and rare. The rising interest rates mean that fixed coupon bonds are declining. That means that the worst 6 months in the bond market have unfolded. Again, that negative 21% is pretty astonishing in the bond market. That's the big news of the year. It's very, very, very rare, to the point of being unheard of, that the bond market loses more than the stock market. And the other thing I would say is that our losses are vastly less than this in our bond holdings because we're not in long-term bonds. We cut back 3 years ago thinking that this was inevitable. We are no longer in long-term bonds, so our losses are much, much less than that. What's happening right now, that may have changed a little today, but it's not really happening yet. Bull markets die in euphoria. In other words, everybody has big expectations, and right now people are expecting that somehow magically the Federal Reserve is going to boost the money supply. They've said again and again that they're going to stop what they did. This is what you're looking at there. My captions are covering up, but this is M1 money supply, and you can see around 2008 it started growing, and then in 2020 it just went off the charts. Probably, you could argue that it kept depression from happening because of COVID and the COVID shutdowns, but one way or the other, we got a gigantic boost in the money supply and in debt creation. The Federal Reserve says they're going to dial that back. Investors don't yet think they're serious. How come I think that? I don't think that investors are serious because the stock market is not down 30 or 40%. The long delayed result of all that money supply, too much money chasing too few goods, is inflation. Today, June 10th, 2022, it was 8 point something, the highest in 40 years. As you can see, it actually went negative. We had deflation there in 2008 during the financial shutdown. We came close to negative rates in 2015 and 16 and in the COVID pandemic. But basically, we are as high in terms of inflation as it has ever been in 40 years. And so we're not used to this, are we? This is all news to us. Now, that's the Wall Street Journal's numbers. High, isn't it, since 1982? And look what happened. The gray area there is a recession. So inflation, I really want to pound on this. Inflation always comes with rising rates. It always comes with social unrest, and we're seeing that. Crime rates are up, dissatisfaction is up. Regime change is inevitable unless the other side finds a way to screw it up, and they might. That's why you're seeing the party in power right now beat every drum they can about everything except for the economy. Comes with a lot of angst and self-doubt and fear. A lot of people will leave the stock market and stay out for the next 5 years this year, which means they'll miss the recovery as well. It's a pretty normal tendency. They can't stand the heat. We're going to see a stock market decline if this is normal, more than we have so far. We're not even really in a bear market yet. We're going to eventually see a recession, and that's when things start to reverse. That's when we're going to see interest rates possibly fall if we don't have stagflation. If we have stagflation, the only cure for it is to raise rates high enough, as they did in the early 80s, to shut down the economy and let everything reset. Resets are not that abnormal. The Great Reset is a political term being bandied about out there. People are making best-selling books out of it. But the reality is that we're always having some sort of reset in something. And the reality is that resets happen about every 10 to 15 to 20 years, and there's always big change happening. So yeah, we're going to have a reset, and no, it's not any big thing, because the next thing that happens is recovery, and we will not only recover, we will go higher. We've been here before. Today also, consumer sentiment hit a 42-year low. This is actually an inverse indicator to me. It means certainly angst and regime change. It also means that, hey, with things this low, we can only start going up. So consumer sentiment to me is a reverse indicator. Now, bonds will recover, especially the short-term bonds and municipal bonds, because they are priced differently, because their maturity isn't as long. You're not locked in as far. You notice that bond market declines. That's these things over here on the orange. That they tend to precede stock market declines, and then there's a recovery. So first you have the bond market decline because of higher interest rates. Then you start spilling into a recession, and then there's a falling interest rate and a falling stock market. The S&P 500 index can go sideways for decades. I kept saying this for the last 5 years. People don't believe it, but it can. In 1968, it went sideways because of inflation, and it stayed there for a decade. This does not mean at all that all investing won't work. It just means that the go-go growth stocks that have dominated the last decade will not be in charge if it plays out as it normally does. In fact, let's take a look at what happens during rising rates. The green stuff up on top is attractive, and that's high quality value stocks. That's because they usually are in cement or commodity production or something really basic that people can't live without, diapers, something like that. International equities do well and will do better this time, and I'll get into why I think they're going to do better. Emerging markets sucked bad when there was a debt crisis overseas. Value stocks tend to do well. US, now you're getting down to the place where they're not really that attractive. And then you get down into growth stocks and real estate, and they get nailed. So it's going to be a great reset in the sense that growth and real estate may take a break here. Now, my case here is that we're going to want to be in value stocks. Why haven't I gone into them yet? Because value stocks tend to get pummeled in recessions. And I'm waiting to see more signs of a recession because I'd like to get the stock market lower before we buy into them. However, international stocks are already sucking eggs. And one reason is that, look at this dollar to the Japanese yen here, 20-year highs, 20-year highs. And we're seeing that all across the board. The dollar is high at decades highs, and it's not going to stay that way because other national forces and other entities like the European Central Bank are going to raise interest rates to curtail inflation, and the dollar won't be as attractive. So we want to move on that relatively early and carefully. International investing has been really successful, just not recently. If you see, here's the international stocks, 1970 to 2020, that's 30 years. Well, no, it's 50 years, isn't it? I've had a long day in the stock market. Can you tell? US stocks did over a 50-year time span, did an average of 10.7. International stocks did 9.3. So it's not like international sucked. It has sucked in the last 5 years. Now, what I'm thinking about is, on Wednesday, my youngest daughter just got promoted out of elementary school. She was in the 6th grade. Now she's going to middle school. And I was standing there at the school thinking, you know, I have been taking kids to elementary school for 27 years because I had a long span between kids. What would have happened if I had taken $10,000 and put it into different mutual funds and just left it? And you know what? The truth is I did. So let's see what happened. That's the Vanguard Index 500. That's orange. It did 10,000, became 120,000. The blue one is a global asset allocator, First Eagle Global. It did 122,000. So international more than kept up. Dodge & Cox Balance, which is basically a 70% stock, 30% bond, did 105%. 105,000, 9.22% annually. The point is that this includes two of the worst bear markets in history, the 2000 tech bubble and the 2008 financial crisis, and it still rocked. And international did great, relatively speaking, compared to bonds, which did 3.76% and made $10,000 into $26,000. So that's short-term bonds. Now, the past is not going to be like the present. We can't say it's going to do that again. But the lesson is there that international investing can work. The 15 years before the Fed started stimulating from 1995 meant that international outperformed because the Fed wasn't stimulating. The dollar was high and becoming lower. That was good news for international investing. The First Eagle Global, again, this, I can't say that this is going to repeat, but the First Eagle Global did an 11.62% average rate of return, and the S&P 500 did 6.69%. So if the Fed's not stimulating, international can do well because they tend to have more commodity production. So what if we're wrong? Somehow magically this all reverses and we go back to the growth boom years. Well, there's number 4 is the Vanguard Index 500. Again, that's the stock market. That since 2010, it has delivered 14.59% a year. Just epic. But First Eagle did 8.14 and Templeton Growth did 6.82, which still beats short-term bonds, which only did 1.86%. So the answer is, if we trickle carefully into international, we really don't know what's going to happen because we can't tell the future. But the odds are reasonable that we'll outperform bonds, which is our only other option if we're not straight on in the stock market. We tend to think that today is going to be the way the world looks forever. I took my daughter to kindergarten in 1995, and I thought, this is the way the world's going to look forever. Actually, school changed dramatically. There were no fences back then. It was a community hub. Now there are fences, and the school is like this opaque factory that sits in the middle of our communities. So the world changes. It always changes. Today is not going to be the same as tomorrow, and we have to invest that way. So have a great weekend. Give this some thought. If you see some trades going into your portfolios, that's what's going down. And value comes later. Be careful. We really don't know the future. Call me if you have any questions. Thank you very much. Blessings.